Hello, my name is Jonathan Miller, and I am the Deputy Director of Policy and Research in the FDIC's Washington, D.C. office. It's my pleasure to welcome you to this presentation on the ability to repay and qualified mortgage rule. This video is part one of a three-part FDIC series covering compliance with the mortgage rules issued by the Consumer Financial Protection Bureau, or the CFPB for short. These rules became effective on January 10th, 2014. This video is specifically designed for community bank compliance officers, though we hope it will be helpful to anyone who needs to understand how to comply with these rules. This video series is part of the FDIC's ongoing efforts to provide technical assistance resources to our supervised institutions to help them fulfill their compliance obligations and understand key regulatory issues. This presentation has been prepared by FDIC staff to provide some additional insights and information regarding the ability to repay requirement and the ways creditors can demonstrate compliance with that rule. Originating a qualified mortgage, which we know has become a familiar term to bankers, is one way to demonstrate compliance. In this video, we will sometimes refer to the ability to repay qualified mortgage rule as the ATR-QM rule for short. In the next segment of this video, we'll cover some highlights of the ATR-QM rule. We'll provide more details on those highlights throughout segments 2 through 6, with a focus on those aspects that we think are of special interest to community banks. Then in segment 7, we'll address some broad issues we've heard about concerning compliance with the rule. In segment 8, we'll provide some suggestions for effective compliance management tailored to this rule. And finally, at the end, we'll provide you with some resources for further, more in-depth information and guidance. As you'll see in this video, there are special provisions related to small banks with respect to the QM requirements. Small creditors, 1, get a much broader safe harbor for qualified mortgages than other creditors. 2, are not required to meet a specific debt-to-income ratio as long as the determination of the ability to repay is reasonable for that customer. And 3, may continue to write certain balloon loans that have qualified mortgage status. This video presentation does not address every single aspect of the ATR-QM rule. We strongly encourage banks to always look closely at the actual rule itself and the corresponding official interpretations. We include these sites at the end of this video so you can easily locate them, along with a number of other resources for you to consider. And remember that it is the CFPB that has the authority to issue this rule and official interpretations of it. Joining me for this presentation are 3 others from our Washington, D.C. office: Serge Sen, Section Chief in Supervisory Policy, and Elizabeth Khalil and Glenn Gimbel, both Senior Policy Analysts. And now I'll turn it over to Serge Sen in Segment 2, where we'll begin discussing the highlights of the ATR-QM rule.